And just when the bulls thought everything was going according to plan, the hot NFP number steals the show. NFP rocked the boat, leaving the macro bros in shambles, bulls scratching their heads, and even the bears throwing in the towel. So with the data out and the labor market intact, the economy roaring, what does this mean for yields? That's what we're here to talk about today. FOMC is next week, and with cooler inflation, hotter jobs, the Federal Reserve is now left with a seemingly difficult task in setting policy. And while the overall sentiment is no cuts in June, what's more important is the dot plot and where the Federal Reserve sees policy at the end of 2024. So will it be 2 cuts? Will it be 3 cuts, or will it be no cuts at all? That's what we're going to try and decipher here today. Also, we'll be talking about earnings, sentiment, seasonality, and how we should position our portfolio during rate cuts. Will technology stocks continue to be the big winner, or is it time to look at other asset classes? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. Very interesting day here. Some winners, a lot of losers, but overall a fairly flat day in the market. A lot of the selling was a lot worse at the start of the day. In fact, a lot of stocks piled a lot of their losses after we got that non-farm print. So the expectation was 185,000. We got 272 in the non-farm. So a very hot non-farm. So people have jobs, but that did tame rate cut expectations. Again, very mixed action. Let's just look at the big guys. Nvidia, Microsoft, right? They were down flat on the day. Apple, very upbeat. Google, the worst performer, down 1.35%. And then Meta, Amazon, Tesla, flat/down here for the day. So you can see very mixed action. Some winners, some losers, some in the middle. And that was the theme throughout the market here today. The best performing sector, financials, I don't really know why, except for data services and asset management. They just took it on the chin. Good action in banks, insurance, as well as credit services. Visa, MasterCard leading the way. Capital One, the best performing stock right here, and then PayPal up 0.42%, and actually the second best performing stock in the S&P 500 this week. The worst performing sector was basic materials and utilities. Some very ugly action, particularly in copper, agricultural stocks because of commodity prices, steel, and then gold right here. Very ugly action as a whole. So if you're in commodities at all, rough day for your portfolio, as well as utility. So anything that was rate sensitive or commodity sensitive definitely took it on the chin today. And we can see that. Look at the worst performing sectors. GDX, metal mining, commodity driven sectors, right? Then we also had XLB right here, and then XLU, all commodity driven sectors. Then we look at the rate sensitive sectors, XLRE, ITB, so home construction and real estate. The worst performing sectors were simply commodity driven sectors, rate sensitive sectors. And then where were people putting their money to work? They were looking at stuff like IGV, XLK, XLF. So, big names, strong balance sheets. And that's where money was going into today, as well as growth. So sort of like a flight to quality, a flight to stocks that'll benefit from higher for longer, and then everything else in the middle with the SPY returning 0.12%. And again, the action here pre-market. So this is the zero line. Early morning, almost every single sector was down after that very hot non-farm prints. Yes, people have jobs, but the Fed is wanting the labor market to be tamed ever so slightly. But let's hop on the charts and talk about everything else. Okay, so just looking at what the major indices did for the day today, the S&P 500 and Nasdaq were down 0.1%, but in early morning trade, because we actually gapped down here in the morning and actually sold off in a very early part of the trade. We were actually down pretty heavily in early morning trade. If we actually hop on the 5-minute chart and just measure it from the open to the low, at one point we were down 0.4% in the S&P 500 after we got that jobs number, and same here with the Nasdaq. But we actually did par a lot of the losses, made a new all-time wick high on this daily chart, which is very interesting, but still closed ever so slightly down for the day. Very volatile day here in the market, and even in positive gamma, quite a bit of volatility was realized today. The IWM was probably the worst performing sector. Small caps are down 1.17%, and small caps really need these rate cuts. We pushed rate cuts from September into November, and we just saw them dump on that news. The RSP actually held in there, only down 0.31%, but definitely still the market cap weighted indices outperforming. Mid caps were in the middle between the S&P 500 and small caps, down 0.77%. The SP 600, like the IWM, took an absolute dump. And part of the reason why it's just yields, we got the hot NFP 272k jobs added, expectation was 180, and as a result the 10-year yield was up 3.4%. I mean, we had just broken below this 4.5 area, and we had just broken below the 4.3 area, and we just spiked up all the way back to this 4.4 area. So we have to see what is going to happen here with yields overall. Very volatile action in yields, but you look at this chart, just look at the price action as a whole. So we put in a high right here, then we put in a lower high, and if we do actually reverse from here, this would be a lower high. We then put in another low below this 4.3 mark, and we would literally be looking at a lower low if we do that. However, yields need to act very, very quickly, because if we start pushing towards these levels up here, break this high, that's going to be a higher high in yields, and then we can actually see a bit of up momentum in yields in bonds leading up to next week's FOMC. But again, it's all dependent on the macro, and a lot's going to be dependent on what the Fed says next week. I don't think there's going to be any changes in policy, but we're going to look to what is going to happen for July, September, and November. Now, gold miners took an absolute dump today. If we actually go to sectors, actually see stuff like XLB down 1%, right? Utilities down 1%, XLRE down 0.7%. Now that was on the back of yields. Yields rose, and when yields rise, cash becomes more attractive. What are you going to sell? You're going to sell gold, and gold looks very, very ugly right now. This was this key support level we were looking at, the 2300 area. Gold looked very constructive up until this point. We got the NFP numbers, and then gold actually dumped, falling below the 2300 mark, and we're going to have to see what happens here. We can actually find support and then move, and then we would say that would be an equal low. But if gold's price action continues lower, that's going to be a lower low, and then we probably want to look to the 2160 area for support. Very similar situation to silver. It doesn't look quite as ugly, and it is actually finding support here at this 28 region. So, with silver, find support, move higher. But again, it's going to be dependent on what the Fed says next week. A lot of these commodity markets are dependent on that. Now, the dollar rose as a result. Part of the reason why we saw a lot of initial shock in the S&P 500 and the Nasdaq, especially early morning, and we did close at the highs. But again, we have to see what policy changes are going to take effect next week, particularly for the rest of the year. It's all dependent on the Fed. And then crude's just doing its own thing. It's living in a land of its own. Very, very weird situation. But let's dive into the S&P 500. Now, let's actually look at the weekly chart, because the weekly candle just closed. Now, firstly, looking at the advanced decline line of the weekly chart, not looking constructive. We've gone ahead and made a new all-time weekly high, constructive, but we actually did see a decrease in the advanced decline line. That's not constructive at all. Now, let's actually just remove these drawings and actually see very interesting. Now, guys, you look at this chart. This is very, very bullish. We put a low, higher low, higher low, higher low in the context of making higher highs and a new all-time weekly high. Last week, we were looking at the weekly chart and saying, hey, this is looking a bit scary. Now we're looking at this weekly chart and saying, yeah, a bit of selling did come at the top here for sure, but we saw a lot of buying at the bottom, and that is a weekly all-time high. Now, just looking at the monthly chart again, we're looking at monthly highs at the moment. Diving back down to the daily. Now, the daily is looking less constructive. There's a lot of non-confluence factors in the S&P 500. Last week, the monthly and daily looked good. The weekly looked bad. Now, the monthly looks good. The weekly looks good. The daily not looking that great. And we can actually see that, yes, we did go put in a high, but this candle right here, looking at this candle, the location and structure, not looking good. A green candle, yes, but it was a gap down. That's why it was green. And we closed in the bottom half of the candle. Very, very non-constructive overall. That being said, we did go put in an all-time wick high, and that is constructive for the most part. But just this overall structure doesn't look that great. So what do I expect next week? I think we're going to see a little bit of a pullback into the FOMC meeting. And then from there, if Jerome Powell comes out dovish or neutral is de facto dovish, market's probably going to find support and bounce. If not, we could actually sell all the way to as far as 5250 in my personal opinion. So again, very key level is this 5250 area. That's the area I want to look to. We use it as support right here. We use it as support right here. And if we do pull back, I think this is where we're going to find support. But firstly, we want to look to the 5300 to find support if we do pull back, and then the 5250 area. And I do think we're probably going to drift a little bit lower into early next week, into Tuesday next week when we get the FOMC, and then we'll go from there, and then we'll make our move. If the Fed come with real hawkish sentiment, I think we're going straight to 5250. If they come in with dovish sentiment, I think we're going to find support here at the 5300, maybe the 5325. and then we're going to go from there, make new all-time highs. With that being said, you have to look at this chart overall, and we are in a bullish trend. Okay, look, higher lows, higher highs. We made a new all-time wick high today, a weekly closing high today, a closing daily high yesterday. This is very constructive price action, and you don't want to take any shorts. You just want to look for opportunities to buy, and I think that first opportunity is going to come at 52.50 if the Fed do come out hawkish next week. So that's what we're looking at. The 52.50 area is our first load the boat zone for next week if we do get there. If not, I do see higher prices ensue in the S&P 500. Below the 52.50, I get quite bearish for the week. I'll give you guys an update as to what happens below there the closer we get to this level. Diving into seasonality, sometimes it's good to take a step back and look at, just the average performance in the last 50 years, each individual month. Now, they're ranked in this table right here. They are ranked in terms of average return, the best month to the worst month. And we can see here that November is the best month in the last 50 years, returning 1.9% on average, 36 up years, 14 down years. Very interesting. Then in second place, we have April, then March, December, October, January, July, May. And the 9th best month, or the 4th worst, is actually June, the current month we're in. Average return 0.52%, 31 wins, 19 losses. So very, very average returns. And you can actually see this is quite interesting. In the last 50 years, both August and September actually have negative return parameters. August just 0.05% and September 1.16%. Very, very bearish momentum here in September. And this is part of the reason why I put out this tweet right here, which was buy in June, buy in July, buy in August, sell in September, buy in October, buy in November, buy in December. And if we break it down further, when the trailing quarter is greater than 5%, which it is in 2024, the return parameters for June don't actually get much better. You can actually see average return 0.62%, 11 and 7. So very, very average returns here in June. So if we do get a bit of volatility in this month and maybe even next month in July, don't be surprised. We are in a period of the year which tends to have quite a lot of volatile movement. And that's the price we pay for the outsized returns we get for investing in stocks. But you really shouldn't concern yourself with intraday or intra-month small-term price movements, because at the end of the day, in the very long term, valuation is all that matters. And that's what we really do on this channel. Sure, I tell you my prediction, what's going to happen day to day, week to week, but ultimately we are investors over traders. And in the very long term, valuation is all that matters, especially after the 5-year period. After 5 years, valuation really tends to play a big role in the stock price, particularly PE to EPS. This right here is normalized PE versus S&P 500 returns. And you can see that after 10 years, 11 years, the correlation is well above 80%, closer to 90%. So if you are a long-term investor, don't just buy growth for growth's sake. I would say that the best course of action for very long-term sustainable investing is growth at a reasonable price. Now, price to earnings is one major multiple that we look at, and we actually keep track of the E segment of PE on this channel quite a bit. And continuing with that, we can actually see that quarterly year-over-year bottom-up EPS growth trajectory for the S&P 600 and the S&P 500 is expected to continue to recover. Now, we are expected to see small caps ramp up earnings here over the next 4 quarters. You can see this is the first and second quarter 2024. We're still yet to report these earnings, but we are expected to see a huge ramp up well above the 20% mark here by the 4th quarter 2024. Then earnings are expected to decelerate, however, still remaining well above the 10% mark here for the S&P 600. And to be honest, large cap earnings are not bad as well. Very similar situation. We are expected to see them ramp up into the 4th quarter of 2024, and then they are expected again to decelerate, but still remain well above the 10% range in terms of earnings growth quarter over quarter. And what will companies do with all of these earnings if they are to materialize? And according to Goldman, they're going to be spending it on buybacks. Buyback authorizations through May 24th is sitting at $608 billion. In fact, a slight increase on a year-over-year basis from 2023 into 2024. And I dare say we may actually go ahead and break the 2022 record of $657 billion in share buybacks. We might go do that. The year is not over. We are only in the month of June, and this is going to be very, very supportive for equity markets as a whole. But buyback driven earnings per share growth is mostly a zero interest rate phenomenon. You can actually see here that net buyback issuance was pretty much non-existent from about 1998, 1999, 2000, and really started to ramp up about 2008 then. thereafter. Now, this phenomenon was on the back of pretty much interest rates being at near record lows, and while they are low right now, interest rates are actually increasing, at least real rates. Now, what does real rates mean? So let's say we have an interest rate of 4% and an inflation rate of 2%, right? The real interest rate there is 2%. It's just the one subtracted from the other. As inflation falls, as we are in this disinflationary environment and interest rates are staying where they are, at least the Fed funds, the real interest rate, real rates, or real Fed funds is actually increasing. In other words, debt is becoming more expensive on a real-term basis because inflation is decreasing. And that's part of the reason why the Fed wants to cut rates. They want to cut rates to normalize the real Fed funds rate, to normalize policy, to normalize the yield curve. And after Friday's NFP, it does look like we are officially set to get this first rate cut here in November. But it's very interesting. There's only a 46.9% chance of a 25 basis point cut. But if we combine these two, we actually have a 57% chance of a rate cut between 25 and 50 basis points. So even though market pricing is pricing in the first cut here in November after the election, I think that's what the Fed kind of want to do. They don't want to get involved in the politics. It does look like we could actually see a 50 basis point cut in November. So maybe we just skip the September one and go straight to the November one. But you do have to understand that there's also a 49% chance of a rate cut here in September. So the odds are pretty much the exact same. It's just that it's not quite 50% for these two here in September. But I think as the week progresses, we probably will see it fluctuate between a rate cut between September and November, especially given next week's FOMC. Now, what happens to equities after the Fed cuts rates? Now, this is some very, very interesting data. This is S&P 500 performance during Fed cutting cycles. And this is what happens when we have a soft landing, the overall average, and then a recession. So this is where we are right now. So pretty much no recession versus recession. When the Fed cuts rates, if there's no recession that ensues, in other words, they want to normalize policy, in the subsequent 12 months, we actually see average returns of about 12 to 15%. But if rate cuts are due to a recession, we actually see negative returns up to 10 months, peak drawdown very close to 5%, but 12 months later closer to 2%. The average is here in the middle at about the 7 to 8% range, which is about the S&P 500 average return in the last 10 years. So this is what we're looking at right now, soft landing, the Fed cutting rates to normalize policy. And if they do cut rates, that's really going to be supportive for equities over the next 12 months. Now, if you want to extract even more alpha from the S&P 500, you can actually have a look at small caps. Small caps tend to outperform after the first Fed cut. This is small caps relative performance versus large caps around the first Fed cut. Now, this is how this chart works. If this bar is going up, small caps outperform. If this bar is going down, large caps outperform. And it's just the alpha on top of it. So you can actually see here that after the first rate cut, this line right here, in the first 1 month and 3 months, the performance of large caps versus small caps tend to be about the same. Whereas as we go into the 6 and 12 month mark, small caps tend to outperform large caps with a very high hit rate above 2% and 12 months later above 4%. So if you want to extract even more alpha from a rate cut in an environment where the Fed is just looking to normalize policy, look at small caps over large caps and even look at stuff like small cap quality that are undervalued relative to their underlying earnings. Now guys, looking at the Fed's GDP now, I swear we look at this indicator every single week. Now GDP actually moved up significantly, now sitting at about 2.66%, and that is because we actually saw a huge movement in auto sales, M2 to 3 manufacturing, ISM non-manufacturing, and then international trade. This happened on the 4th, 5th, and 6th of June, and it was because of the better than expected ISM manufacturing numbers we got early on in the week. This moved GDP from where it was at 1.8% down to 2.6%. So this is everything that moves the Fed's GDP now. I'm sure next week, once they add the NFP data in here, the employment data, we should see this number move as well. But all in all, just to let you know that GDP is now actually tracking in between the 2 to 3% range and actually closer to that 3% range right there, which is very, very healthy. And in an environment where growth is healthy, stocks will rally. Now let's talk about NFP, guys. So we probably all know what the data was. NFP came in hot at 272,000. And just to give you guys a bit of context, right? On the side right here, Goldman were expecting 160,000. That was their estimate, right? BofA were expecting 200,000. 200K. So you can actually see that the consensus here was somewhere in the middle. No one was right. Not the consensus, not Goldman, not BofA, not a single investment bank or research firm predicted a 272,000 non-farms number. It was a very hot number. It was part of the reason why yields spiked, commodities dumped, and equities started the day on a huge gap down, especially the S&P 500 and the Nasdaq 100. Private payrolls was hot too at 229,000. We saw average hourly earnings month over month increase by 0.4%, 4.1% for the full year. So wage inflation back above that 4% number. You know the Fed don't want to see that. The participation rate pretty much came in line, but was really surprising was that the unemployment rate actually increased to 4%. So despite all of these jobs being added, there's still more people adding to the economy. This is via stuff like immigration. I think if the unemployment rate was anything less than 3.9%, we would have seen a bigger dump in stocks and higher yields. So this did tame a bit of the movement we saw initially intraday, but all in all, a very hot number. But you do have to look at the grand scheme of things. Yes, this is going to affect price action in the short term, but long term, this is pretty much telling us the economy is strong, the economy is robust, the labor market's robust, and the economy is adding jobs. People have jobs, which means people can continue spending. Good for the consumer, good for stocks, good for the economy. This is actually what you want to see, and this pretty much takes away any fears we had about a recession. Both got a note here about the non-farms, and they say the bottom line is that the stronger than expected May employment report remains consistent with our monetary policy outlook for staying on hold. The report showed solid payrolls gains with positive implication for consumer spending. We expect the Fed to stay on hold for now and start a gradual cutting cycle in December. I personally think September, November. And they say, which will depend on a moderation of the inflation data. The economy may be cooling, but it is not cool. Strong payroll gains continue to be supported by services. Establishment payrolls grew by a stronger than expected 272K in May, offset by slightly downward revisions in prior months. Service providing sectors added 203,000 jobs. Education health is the main engine. It rose 86K. Leisure and hospitality added 42K. We think this sector will likely see more subdued employment growth going forward. Overall, strong services payroll point to solid activity in the services side of the economy, which is the major driver of US economic growth. So guys, yeah, at the end of the day, we did get a hot number, but this just is very positive for consumer spending. We're seeing job gains in the right places, but it's very positive for consumer spending, and it should support a stronger economy. And all this is going to mean is that it's just going to take a little bit longer for inflation to cool. But at the end of the day, what do you want? A weaker economy and rate cuts, or a stronger economy and later rate cuts? The second, of course, and that's what we're getting right now. So you want to be long equities in a market like this, and you want to sit through the volatility, guys. Now, looking at a couple of other charts we don't really get to, this right here, payroll growth tends to slow in May when the labor market is actually tight. So you can see here that the spring hiring season, we have a ton of hiring. After we get out of this hiring season, the market tends to be tight, and then payroll growth actually tends to slow until we bottom out here in the September, October, November period, which is the end of year Christmas time period right there. Looking at another chart, immigration has actually slowed sharply since the start of the year. So all of the big fuss that was made by Republicans with Biden's immigration policies, we've actually seen a sharp decrease in this right here, and trust an election year for politicians to actually get shit done. Moving on, credit card delinquencies have actually risen. This is a short-sighted view from 2021 to 2024, but when you look at the big picture, credit card delinquencies remain ultra low, very, very low, until we actually see this number get to about here, maybe even like up here. Credit card delinquencies are actually at historically low levels, and we can actually see in the last couple of months it has actually fallen as a result, and this has to do with disposable income and employee compensation. It continues to outpace inflation. You can look at the 1 year, 6 month, and 3 month annualized versions, but PCE at 2.7%, employee compensation continues to be at 4.1% and 5.7%. It means pricing power for the average consumer is higher, despite what you hear in the media, despite what everybody tells you. Consumers' incomes are actually rising faster than the pace of inflation, and that's why delinquencies are at historic lows, and why the consumer has remained incredibly resilient over the last 2 to 4 years in the US economy. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.